All right, folks, welcome back to the Property Couch podcast, and we've got an amazing episode lined up for you today. We are talking to a very special guest. He's written a book, and he's going to tell us how not to lose $1 million. Surely you want to learn how to not lose $1 million. What else do we cover, Ben?
Bryce, you definitely don't want to lose $1 million, but you also want to have a mindset that's amazing. And guess what? This special guest is also going to talk to us about how you can recover from anything.
Ooh, I like that. How to recover from anything. That sounds intriguing, folks. Let's rip into the show.
Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council of Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance, and money management.
All right, folks, welcome back to the Property Couch podcast, and welcome back to you too, Ben. How are you, buddy?
Mate, love being here. Love Thursdays. Love talking all things property, finance, money management. It's good to be here, mate.
But I know we've got a special guest today, someone who's put their life's learnings into a book that you can read in a weekend, Ben. You can get their 10,000 hours in a weekend. So super excited about having a conversation with our very special guest today. But before we get there, Ben, a little bit of housekeeping. Yep. Just a little reminder that last week we launched our TPC podcast companion. We launched Opti into the world, Ben. So we've got a ton of people who have been checking it out during the week, Ben, which is super exciting for us. But if you didn't catch that last week, what we want to do is to click in the show notes. There is actually an opportunity for you to engage with the Property Couch podcast companion, Australia's first all-encompassing property investing AI solution, Ben, on WhatsApp. Click on the link. Ask us any question. Ask us what the buyer's decision quadrant is, Ben. Ask us the 4 ways that a property investor will pay. Ask us how many podcasts we've done. Ask us when we started. Ask who Ben Kingsley is. All that sort of stuff. You can actually do that in the podcast companion. So, folks, click on that. We are super excited about that. We'd love for you to test it so we can make sure that gets better and better and better, Ben. But
and Bryce, you know what I'll be asking about?
What's that?
I'll be asking. Tell me about Money Smarts. Tell me about how Money Smarts is a rules-based money management system that can organise my finances, get me in control of my money, trap surplus, and then help me put that money to work.
Yes.
So that's what I'd be asking, and which is a good segue into a final reminder about the webinar we've got coming up next Tuesday, the 26th. Check it out. We've got lots to talk about in terms of Money Smarts 2.0. We've supercharged Money Smarts. We've integrated it into the full more platform. So we've got plenty to talk to you about. Because if you've tried Money Smarts before and you've just, a bit like the gym, you just sort of let it go to the side and you want to reboot, it's a good time coming into the summer series, which might inspire you in terms of taking action. I mean, this is the time where we want to be careful around our money coming into Christmas and all the temptations associated with that. So, yeah, we're really excited about that. So please register, come along. Spots are limited, so make sure you jump in there as well.
Limited seats available, Ben. So, yes, definitely register for that. That will also be in the show notes. Hey, Ben, just a reminder about I'm donating my 50th birthday next year.
Yes, how good's this?
Last week, I announced what that looks like. So if you missed that, we're going to put a link in the show notes. There'll be a little grab of me talking about what we're doing. But it's just a reminder for anyone. If you're hearing this for the first time, definitely go and click on this link because we want to hear from you. Looking for a select number of people who want to join you and me, Ben, on a once-in-a-lifetime experience, and which we think will be just purely transformational.
Be fun.
If you want to learn out more, you go to thepropertycouch.com.au/Bryce's 50th. There's an opportunity for you to get involved. There'll be a video there. You'll be able to see the announcement that I made last week. But Ben, I cannot begin to tell you how I'm excited I am about.
You should be super excited, mate. It's
donating my 50th, raising money, helping people get their eyesight back, as well as you and I being able to spend time with people who have got hearts to help other people and want to acknowledge how blessed they've been to bless others. So that is something I'm super excited about. So if you don't know what I'm talking about, Hey,
The target is 50,000, right?
$50,000. Yep.
Now it's 49,000, Bryce,
Yes.
because the Kingsley family are going to put $1,000 towards the target. So there you
Ooh,
go. You're off the mark
thank
and
you,
then some.
Thank you,
Then
Kingsley
some.
family. I
Merry
put,
Christmas. Merry Christmas.
thank you,
The
sir.
last of our regular shows. We're going into summer season. So there's a little gift for you for your 50th.
Thank you, sir. Appreciate that. I'll be putting my own money into it too, folks. We won't be asking you to do something we're not prepared to do ourselves in the Holdaway family, but it'll be a very, very, very special experience. So if we've given any value to you over the journey and you want to come and spend some time with Ben and I, please do that. Ben, we also talked last week about a very exciting and challenging opportunity.
Yeah, look, we're looking for our next COO. So the person who's going to be basically 2IC in our advisory business and control and run that advisory business. So reporting into yours truly. So we've got a really incredible sort of plan to try and make our advisory business one of the premier advisory businesses across the country in all things around tax, property advisory, financial planning, mortgage broking, and of course our buyers agency business. So really, really exciting opportunity. So I am looking for someone who's Melbourne-based, 10 years leadership and management experience inside the financial services area, and a big focus on people, culture, putting the customer first, and a real fascination around digital transformation and digital technologies as part of the service solutions and value propositions we're going to bring to the table. So if that is you, if that sounds like a challenge and an opportunity that you want to put your hand up for, my LinkedIn details are there. So obviously private message me. And you'll also see inside the show description there, the link to the Seek website as well, which has that job application open right there, right now.
Call me biased, Ben, but I don't think there's any better opportunity in our lane going for 2025. So if you're a heart for someone who likes to help others, which is really the mission of this podcast, and it's definitely the mission of our business, we definitely want to hear from you. So reach
We
out to
are
Ben.
expanding. We are expanding. We need more great people.
Yes, definitely. So, and finally, Ben, next week is summer series. It is here.
Woo-hoo!
Have we got some incredible stories of transformation as we are well and truly nudging Christmas and summer and all camping and relaxing and all that sort of stuff. We have got a series lined up
We have.
like no other. So you should definitely check that out, folks. And Ben and I have very much enjoyed having some of those conversations with those people as we launched into December and January in that series. So want to make sure that you check that out. Hey, Ben, let's get on to our very special guest today. Before we get there,
Yes.
I've got a Mindset Minute theme, which is really just going to frame up the discussion that we're about to have today.
Beautiful.
Success in investing isn't about never making mistakes. It's about learning from them, adapting, and coming back stronger. Each misstep is a lesson in resilience and wisdom. Setting it up, folks. We have got a very, very incredible guest. That quote will make so much more sense as we have that conversation, Ben. But let's cut to the conversation you and I recently had with our very special guest today. His name is John Addis. All right, Ben, we've got a very special guest today with us on the Property Couch. We're chatting with John Addis, who's the founder of Intelligent Investor and author of How Not to Lose $1 Million, Win at Investing by Losing Less, a book that masterfully explores the valuable lessons learned from investment missteps. With a long-standing fascination for investing and understanding what makes good businesses thrive, John has built a career turning complex financial concepts into accessible, impactful insights. John's expertise spans across various platforms, having written for prominent publications like the Sydney Morning Herald and The Age. He holds a degree in economics and he humorously questions why. We'll get to that shortly. And is a founding partner of private media, owner of Crikey and The Mandarin. He also serves as a director of the online portfolio manager ShareSite, blending practical experience with thought leadership. Beyond his professional accomplishments, John is known for taking calls from his 3 adult children, perfecting roasted potatoes, and indulging his passion for the English Premier League football. Now, notably, despite fitting the stereotype of a seasoned financial expert, John has never had a beard. We're excited to dive into his journey, learn from his wealth of knowledge, and uncover investment insights that resonate with property and general investors alike. Welcome to the Property Couch, John.
Thank you, Bryce. Thank you, Ben. I don't know who wrote that intro, but they should be shot.
Oh, anything inaccurate there, or just because it was too long?
The beard bit's accurate.
Yeah. Hey, we're excited to chat with you. You've got a wealth of experience, John, that we want to tap in today. But your book, this one here, that everyone can see if they're watching, encourages readers to embrace the lessons from their mistakes. So what's the biggest misconception people have about making mistakes in investing, and how did you come to realize its importance?
The biggest misconception about mistakes, I think, is that they're a lot more common than what we would hope. It's so easy to make mistakes in investing in shares. And I suppose that the premise of the book is that you kind of have to welcome that. I think in property, where the transaction costs are probably far higher, and once you get into a house, you can't really sell it again without incurring a huge loss if you want to turn it over quicker. It's not like that with shares. Shares makes it really, really easy for you to switch when you change your mind. And that can be a danger as well as a plus. So the capacity to make mistakes in investing, I think, is probably greater. And the capacity for learn from those mistakes is probably greater too. So that would be what I would say is the biggest misconception. You're going to make a lot more mistakes than what you think.
We're going to come into that a whole lot more shortly. But before we do, we want to get to know you, John. So let's take us back to the beginning. We'd love to know what conversations were like growing up in your household. Did your parents exchange ideas around money, or did you learn by osmosis?
It's fair to say I learned nothing from my parents in terms of money. They thought that all sort of financial material problems would be fixed when the UK became a socialist country in about 1977, I think. And obviously that didn't happen. So, learning stuff about investing, talk about that stuff, it wasn't just didn't happen. There was a kind of dirtiness to it. Yeah, and I think that was something that it took me a long time to get past, to be honest. You don't really need to know a lot to set yourself up later in life. You need to understand, I think, the power of compounding, the value of doing nothing, and the value of managing your budget and saving regularly. And if you do those three things, I think you'll probably do all right no matter what you invest in. But it took me a long time to learn that. And I'd always considered myself being good at making money, and through different businesses and stuff. But I'm even better at spending it. And I don't think I've ever really conquered that problem. So I'm trying to teach my kids about the stuff that we never spoke about at home.
So let's get into that, John, in terms of, so paint a picture for what the life was like back in the UK. Who's your footy team? I think everyone would be sort of interested to know your soccer team.
Yeah.
Spurs?
Yeah.
Okay. We'll keep moving on from that.
I appreciate
celebrate
that.
There. But
Love Ange, though. Love Ange.
Oh, yeah, he's great, isn't he?
Great football.
Certainly now on the global stage, so good on him. In terms of, so how many brothers and sisters did you have growing up? Is there any sort of...
One brother. There's a 5-year age gap. My parents' backgrounds were... in sort of economic history, there's an age in Western European countries where the majority of the population goes from working class to middle class, often through education. And that happened for my parents. So both my grandparents were coal miners at some stage. Yeah. And my parents were like solidly middle class. So my dad was a public servant and an engineer, and my mum was a school teacher. They split up when I was about 12, and we went from being, having foreign holidays in Spain and places like that to going away for a week in a caravan in Devon, So there was a big sort of financial sense of insecurity, I suppose, in those years because we were pretty poor. I had my school dinners were paid for by the state. I appreciated the milk that I got in the mornings. I'm not saying my mum was, neglectful in any way. She wasn't, but money was really, really tight, from the age of about 12 or 13 onwards. And I've always had that fear of not having enough money and not, when I do have money, I think the fear of losing it is greater from people who have always had it.
There's no doubt that shows up in a lot of the interviews and research that we also see out there. So, say 5-year difference between you and your brother. Was that older or younger?
He's younger, yeah.
Okay. And you went to live with your mum?
Yeah, we stayed with my mum.
Did you spend time? Yep.
My dad moved in with a neighbour next door, just to complicate the personal story.
Oh, right. Okay.
Which wasn't great for her mental health. And she kind of lost it. And then eventually we moved away, which, well, not moved away, but not far away, just around the corner.
But by those sort of formative years in that sort of 12, 13, this is when you're starting to get conscious about what you have got versus what your mates have got and sort of starting to understand that. Is there any difference between your money mindset and your brother's? So you said you like spending it, but is there a story of delayed gratification or understanding that, or has your brother and you got very similar traits when it comes to money management?
My brother, I would say, is more conservative. He's better at managing his budget. He probably wouldn't have done the kind of things that I've done, but he probably wouldn't have needed to because of that mindset. Whereas I've been the person who emigrated, and that, I think when you immigrate through choice, then that kind of signals you as somebody who's wants a different set of opportunities. Maybe I don't think I could have done in the UK what I've done here. So we're different in that respect, in those kind of personality types. So I like taking risks, which is why I'm probably more attracted to investing in shares than I am in property.
Well, obviously there's bigger upside, isn't there? So that sort of makes a lot of sense. In terms of you come out to Australia, how old were you when you migrated?
24.
Okay, so come out, new start. Tell me about the story around money. Was it sort of just, you're living paycheck to paycheck at that sort of stage, having the time?
Well, something interesting happened after I got out of uni. So when would that have been? About 1984, something like that. But I met a girl where I worked, and we worked out that it was cheaper for us to buy a place than it was to pay rent. So I bought my first flat in South London when I was 21, and I bought it on 100% mortgage. And that was when the UK was going through this financial, I wouldn't call it a boom, but there were peculiar financial products that hadn't existed before, and 100% loans were one of them. And they were interest only. And I think the banks who sold those loans have been pulled up for billions of dollars of fines because a lot of them shouldn't have been sold. I know it's probably one of those people they shouldn't have sold to. But I told the girl I was living with at the time I was going to Australia for 6 months. I didn't come back. And about 3 years later, she sent me a check for about $30,000 from the proceeds of the sale of the flat that we had in South London. And that's kind of what got me started. And I used that as a deposit to get a flat in Elizabeth Bay in Sydney.
And away we went.
Yeah.
So tell us what landing in Australia looks like. So what is your...
I couldn't believe it, man. Yeah. I could not believe it. It was way better than what I thought. And I remember coming out of...
Prior to coming, what was in your mind's eye?
Everybody in the UK just thinks that everywhere in Australia is hot. Yeah. Every animal is trying to kill you. And the place is a cultural desert. That's the preconception, which is broken down a bit, but it's still kind of there in the older people.
Yeah.
And I couldn't believe how different it was to that preconception. So I remember the first thing that an Aussie said to me was when I arrived at Sydney Airport and I was just sitting down taking a break, and he looked at me and he goes, "Have you been here before, mate?" And I said, "No." And he goes, "It's a pretty shit airport, isn't it?" That was the first word that an Australian said to me. It's a shit airport. I don't know whether that's changed. He was right at the time, and he might be right again still.
What are we talking? What year, roughly?
This is 1988.
Yeah.
So I can't remember how I got into the city, but I got out at Martin Place and I walked down to Circular Quay, and I just thought this is the most beautiful place I've ever been to in my life. I could not believe that there was somewhere that magical. And I know I'm living in Melbourne now, and Melbourne has its own charms, and they're not immediately visible. But Sydney is one of those places like Paris where Sydney is one of those places where you look at it and go immediately, this is a beautiful, stunning place. You look at the harbour and the Opera House and the bridge, and
best harbour city in
it's
the world.
incredible.
Yep.
So
By
I was charmed right away.
So talk us through. Okay, you've looked at the view down at Circular Quay, but how did you find your feet and get onto your first job and make your way in those formative years in Australia?
I just bummed around for 2 years. I spent 2 years sort of travelling around the country, meeting a load of people. I eventually came back to Sydney.
Blowing that 30K.
Yeah, that's right. No, it hadn't turned up at that point. She was still living there. It turned up, I think, after I settled in Sydney. But the first job I had was I set up a telemarketing department for a financial planning company, which in retrospect, God, some of the things I saw there. I mean, I was kind of naive at the time. Yeah, they were selling savings plans. And I think the salespeople would travel around on buses and hit people up, and when they sat next to passengers and talk to them about savings plans, and they were getting 10% commissions on that. And as I talk about in the book on Timbercore, if your advisor's getting a 10% commission, there's something seriously wrong with the product. If you need to bribe somebody to that extent to sell it, then something's wrong, and something was wrong, and that all got shut down, thankfully. But that was my first job. I was only there about 4 or 5 months. My first proper job was working for a publishing company in Surrey Hills.
And then away we went. So take us to sort of the journey that now you're obviously sort of lead editor and owner of the Intelligent Investor, which is part of InvestSmart, which is obviously where Alan Kohler and all of the sort of greats, commentators and communicators around the sort of property finance, money management, the economy. They're all there in terms of those great operators. What's it like in terms of running a sort of magazine of that nature, or a subscription newsletter of that nature?
The good thing about publishing is the deadline manages itself. So you guys would know that you've got a podcast to do every week or 2 weeks or whatever it is. So that tends to take a lot of the managerial angst out of running a business like that. So once you've got it set up, once you've got people trained, once you've got people, willing to meet their deadlines, then it can become, I wouldn't say easy, but it can become not too demanding from a managerial point of view. So I like it because I get to do what I really enjoy doing, which is reading about finance and stocks and economics to a lesser extent. And I've always been into words, I've always read a lot. And when my business partner at the time, my business partner that we set Intelligent Investor up, he used to work at Huntley's Your Money Weekly, and I knew Ian from a previous job. And when I read that stuff, I just couldn't make head and tail of it. It's just so full of jargon, acronyms, cliches. There was no storytelling at all. And I thought, well, what if you could tell stories at the same time as giving that kind of advice? Could you communicate in a way that people actually didn't feel as though they would be being covered in a wet blanket and then a bucket of sand is being poured on their head after reading it? Because that's how I felt. It was just really turgid, heavy stuff. So that was the idea, was to turn sort of finance research into company research, into something that ordinary people could understand and could act on and actually enjoy reading.
There's a quote in the book, John, and you say, the finance sector trades on complexity, preying on the general misunderstanding of the effects of percentages and compounding to enrich those within it at the expense of the clients it is supposed to serve. That kind of is an extension to what you just talked about, but can you add to that?
Yeah. Well, I think the finance sector is probably about 10, 20, 30, 50 times bigger than it needs to be. And the reason why it is because the fees are a gravy train. And a lot of people have got rich for delivering average performance. And you can see it in the stats from fund managers. If you look at fund managers in Australia, only about a quarter last more than 10 years. And if you look at their average returns, the average fund manager delivers average returns minus the fees they charge. And you talk to an ordinary punter and they go, 1%. That's not much, Or 2%, that's not much. But when the market's returning 9%, as it has done over the past 30 years, 1% is a big number. Like that's 11% of your total returns. And if there's performance fees on top of that, then you can get up to 15 or 20%. And compounding works in both directions. It works on the returns to you, but it also works on the returns to the fund manager or the financial planner. So if you do that over 30 years and you look at your increase in your super and your fund and your financial planners, getting 1 or maybe if they're getting 3%, I think over 30 years, they're taking more than half of the increase in your wealth. And that's what the finance industry trades on. So people don't understand the power of compounding. Percentages sound like a small number, and other people get rich on the basis of that.
Yeah, it's that quote where, someone's showing off their latest boat and their latest yacht, but it asks the question,
where are the
there's
customers'
such
yachts?
from X bank and there's such but the question is, where are all your clients' boats?
Yeah, that's right. There's a book of that name actually from the 1970s called Where Are the Customers' Yachts? Yeah, that's right. They're speedboats now rather than yachts.
What was your was there any definitive book? As you said, you're obviously an avid reader at the time, and you had sort of an interest. You did economics and so forth. What was the 1 or 2 books that you read as a young man that sort of introduced you to the power of compound, or introduced you to the share market, or something like that? You thought, actually, you know what, I reckon I could give this a go.
Well, there was one incident and one book. So I'll tell you about the incident first. And this wasn't until I'd started Intelligent Investor, but we were in Bondi Junction, and one of the analysts would go to this, or 2 of the analysts would go to this Thai place for lunch. It was all you can eat for $5. And that's kind of ridiculous when you think about it. They would go there every day, and I could see them getting larger as time went by. But that didn't, and that's, why are you doing that? Why are you doing that to your body? I said, well, do you know what the value of $5 is, or $25 a week over 20 years? And I'd never thought about it in that way, And I did the figures just before we got together. So if you just save $50, and I told one of my kids this, who was talking about getting an Uber to get back into the city rather than getting a train. And I said, look, at $50, you just in where is it? In 20 years' time at 9%, that $50 is going to be worth 300. Right. And his eyes sort of went, oh. And that's what happened for me when they told me that about the $5 all you can eat. The time value of money in the future.
Yeah.
It's whenever you ask anybody about this question, they will always underestimate the amount that $50 or $100 or $1,000 is worth in 20 or 30 years' time. Yeah, so that was the first thing. In terms of books, I think I've read all of the investing classics. Everybody says you should read Ben Graham, Intelligent Investor. It's a bit of a slog, to be honest. I think you could read chapters 4 and 8. I think that's definitely worthwhile. But for me, it was Making of the American Capitalist, because the strong narrative bias in there. It's basically an autobiography of Warren Buffett, and that was what communicated to me something that I found really valuable, which was, the power of brands, the power of a business that is established and has loyal customers, and it's not too financy. It's really about business and how you develop an attitude towards business rather than the numbers in a business. So that was kind of formative for me.
There's parts in that area about pricing power.
Yeah.
Coming back to your idea about brand and building moats, that you create such an attraction business and such a attraction products that you can keep moving your price, but as you move it, the so-called equilibrium, the price doesn't. So that's that that basic pricing power that you've got off the back of a brand. Right. Hence Coca-Cola and Amex and
Qantas,
all of the sort of great businesses.
About 3 years ago.
John, another couple of quotes from your book. The path to investing success is one of repetitive failure. Studying investments on which you or someone else has lost money is more likely to help you pick big winners, because we learn more from doing things wrong than right. Can you talk more to that? You also said the shadow is what helps us see the light.
Wow, did I write that? That's quite good. I like that.
Yeah, that is good.
Well, I think that can I answer that question by telling you a story? and it is actually a property story. So
I love stories.
Okay. Well, when it was about 2004, and I was diagnosed with leukemia in 2004, and we'd been running Intelligent Investor for about 6 years. And it felt like to me a good time to get out. And my life expectancy at the time was about 6 to 8 years, something like that. And we had 2 children, and I think we had one within a year. So one was either on the way or not far from being on the way. And I just wanted to spend that time with them. So that's when I got out. And we had a day. We're going to move to the North Coast. So we're going to go to Byron Shire like everybody else does. And we had a look at 14 different properties in one day. And the first one we saw, we both got a very good feeling about it. It was a 2-acre block, remote, like kind of idyllic, ocean views, really, really nice. The rest were kind of a little bit urbanized, suburban. And I said, well, let's go back on the way back to the airport. Let's go and have another look. And we ended up buying it. And because I was so desperate to get out, I suppose, I definitely overpaid. And when we moved in, I hadn't done my due diligence properly. I hadn't checked what the neighbours were doing, whether there were any building plans or anything like that. And there was a block in front of us, a guy called Dorsey, who died a couple of years ago. And he had a plan to build a 2-story house. Right? Nobody around there builds 2-story houses because you don't need to. You've got plenty of land. And I thought, oh, my God, I'm so dumb. So dumb. Fancy not doing that. Here I am working in stocks and doing all the due diligence you can think of, and I'm spending $1.4 million, and I haven't even checked with council whether there were plans to sort of block the view. So I thought, this is kind of mad, and I kicked myself over it for months and months and months, maybe even years. Anyway, I split with my first wife, but she's thinking about selling the place now. It's been valued at $6 million. And yeah, good luck to her. But I think that's the beauty of hanging on to something for so long and having that benefit of compounding, and it being, it's basically a tax haven. The owner-occupied homes are tax havens. And I felt terrible about this mistake for a couple of years, and I kicked myself for it. And I went into a kind of, what would I call it? I just didn't trust myself. I stopped investing in shares for a couple of years as well. And that was a mistake too, because it was 2009 and coming up to the GFC, and that was, I could have bought a shitload of cheap stocks and missed out on that too. Yeah. So I think that had I had a willingness to be a little bit more gentle with myself, but actually go into the mechanics of why I made what seemed like a bad decision, because it was rushed, because I was stressed, because I had a health problem, I could have seen it been a bit easier on myself and just let time dig me out of that problem, which is what happened. So I think we all need a willingness to be able to not get anxious about our mistakes, but get curious about them. That's the mentality I think that we need to have in terms of analysing our mistakes, is curiosity rather than blame.
And John, just to round out that story, did the 2-story house get built?
Yeah.
So the house got built, so hence your views were interrupted, but yet here's the story about the value of 2.5 acres in a good location, right?
Right.
And ultimately, or a desirable location which goes against all the fundamentals. Like the economy in Byron is tiny in the grand scheme of things, but it's a lifestyle, and it's got prestige, and it's got that sort of status about it, right? And ultimately, that's what has driven it. I mean, their prices are off about 25% since their recent peak, but that just gives you an idea that when things are good, or when the story that's being told of a particular location, there's buyers who have the ability to potentially get into those markets and do those types of things. So, which is about the nuance I think you're telling in that story. There's nuances in terms of, seeing things at 30,000 feet, seeing things at 10,000 feet, and then seeing things at 100 feet in terms of how you're telling that story. And I looked at the 4 parts of your book. You've got the stocks that we sold too late, the stocks that we we sold
Yeah.
too soon, stocks that we should have not have bought at all, and then stocks that we should have bought but didn't. But basically, so as you're framing up the concept of your book, take us through that thinking. I mean, when did you come up with that sort of theming around how you look at those types of
Well, it's quite
actions?
difficult because, as you guys would know, I think most mistakes are psychological. In some ways with stocks, much like property, I think property in some ways is kind of easier. I don't know, like I'm not really a property investor, but it's easier to get a valuation on a property. It's easier to determine what the yield is. The management isn't going to change. And if it does, it's probably you, or it's going to be an agent, and they're going to do pretty much the same kind of job. Australia's population is going to carry on growing. Nobody's going to come along and invent a whole load of new land, so the competitive environment stays pretty much the same. The tax environment stays pretty much the same, so you haven't got the moving parts that you've got in stocks. But I would say that most mistakes are psychological in shares. I don't know I imagine they are in property investing as well. What's the major mistake in property investing? Overpaying, buying in the wrong location.
Usually it's getting the land to asset portion wrong.
Okay, yeah.
So ultimately it's the land that's going to grow in value. Right. So you want to get the location of the land right, and you want to get the portionality of it right. If you do those two things, you're really not going to fail, in terms of over the medium term.
That makes me feel good about the place I've just bought in Melbourne. So just in terms of the book structure, sorry, but the problem with a mistake in investing in shares is that there's a kind of, it's usually not just one mistake. Maybe the competition changes, the management turns out to be dud, or they're corrupt, or there's some accounting shenanigans going on. There's all of these different factors that combine to cause a mistake. So I couldn't just talk about technical mistakes and psychological mistakes. I ended up with a structure where you talk about the effect. So what was we did sell. There were stocks that we should not have bought at all. There were stocks that we should have bought but didn't. There were stocks that we sold too late, and there were stocks we sold too soon. And the stocks we sold too soon do the most damage.
Or don't they? CSL on listing, sold it when I tripled my money and sold it for $6.50.
Yeah. Wow. I know.
It can happen.
No, I mean, more than once in my case.
Hey John, can we move into, like, double click on some of these points? You said most mistakes are psychological. Can you take us back to the beginning of the pandemic kicking off? Because if you have been doing it for as long as you have, you've seen the GFC, you've seen some of these regular cycles, but that was very irregular at the time. So can you take us back to the psychology at the moment, because you're stewarding people's psychological well-being at that point in time, and trying to help them not panic, do all the things that they've done in the past. But was there anything in that for you as well that really, really tested your resolve around, no matter what happens, we're staying for the long term?
That was, to be honest, the pandemic was kind of easy for us. Mm-hmm. I think in the space of 3 months, we would normally have 10 to 15 stocks on our buy list at any one time. Within the space of 3 months, around March 2020 onwards, I think we upgraded getting close to 40 companies. And there's this phrase about running towards a fire. So it's not necessarily being contrarian, but when everybody else is panicking, that's normally when you find a bargain. And there were so many around in March 2020. It was almost impossible to not make money at that point. You had to be bloody unlucky not to do really well at that point. So, we had upgrades coming out of our ears. Even on, I tell you, there was a sign for me, because they say nobody rings a bell at the top and the bottom of the market, but you do get signs. So the sign that I had was a friend of mine who knows that I work in finance, has never ever once asked me a finance question. And she called me up on March 2020 and said, John, my super's down 20 odd % or something. Do you think I should sell? Now that was the low. March the 20th, 2020 was the low. Maybe it's 21st. And that was a sign of it, you know.
Yeah, getting in the back of a cab and
Right,
just talking crypto
exactly.
up, that's the sign
It's
you
the
get
shoe
out of
shine
crypto,
boy
right?
story. Yeah, that's right.
Yeah.
It was
exactly.
the same with the dot-com boom. You know, I would go to the local computer technician to get my laptop fixed. And I remember him saying, "Oh, what do you think of this company? What do you think of that company?" And I go, okay. I've been going to him for 2 years, and he's never once mentioned any ASX listed stocks. And now he's talking about 7 or 8
retail investors arrive.
Yeah, that's right.
Yeah.
So-
Hey, John, you talk obviously about stocks, but they're businesses, really, right? I mean, ultimately, that's what you're buying into. You know, using sort of Warren Buffett.
That's the
sort of
mentality that
principles.
you should approach it as. Yeah.
Yeah. So in terms of your thesis and your logic, are you looking for the macro trend to be in favour, or are you looking to go counter-cyclical to that because you've just got a good business that just knows how to win market share or has brand or has, you know, that sort of pricing power that we were talking about before? Is it a mixed bag?
It can be a mixed bag. I
looking...
think most of our mistakes have been buying companies that we thought were cheap but weren't good. You know, so they say that, you know, there's a reasonable price to pay for anything. You know, sometimes, you know, you can have an average business and you can get a cheap enough price and it can work out pretty well. But over time, I found that that's where most of our mistakes are. I would rather buy a really good business at a reasonable price than an average business at a cheap price. And I think it's the same with Charlie Munger. And I'd much rather read Charlie Munger than Warren Buffett as well. It's a shame he's gone now because he was kind of a bit of a genius. But
he's amazing.
But it's similar with property. You know, like if you do have those tailwinds of a growing population, reasonably stable sort of political environment, then you're probably going to do pretty well over time as long as you buy at a reasonable price and just hang on through the difficult periods. And it's the same with shares. You know, if you've got a good business, you need a pretty good argument to sell it. You should try and aim to hang on to it forever. You know, and if you've done that with CSL, what's the price of that now? I don't know, $280 or something.
But it's been repriced twice, so it's more like sort of $600.
Yeah, that's right. And the same with Cochlear. You know, and you only need, you know, you said earlier you need superannuation and 2 houses, and that's enough. Well, you only need Cochlear and CSL. And you just hang on to those and put 10 grand in, and in 30 years' time, you'll probably do very, very well.
You've had a 10-bagger, John.
Yes.
You talk about it in the book. It's around Flight Centre. Can you give us the run up to that story and how that sort of launched a lot of what you're doing now?
Okay. I don't think retailers are great businesses. I mean, I own one retailer at the moment, Lavisa, which we've been quite big on. That's done pretty well. We think there's a long way to go with that. But Flight Centre was an exceptional retailer. And I don't know if you've ever read Screw Turner's book. I think it's called, what's it called? Village something Tribe. But it gives you a good insight into the culture of that business and the way that, you know, Charlie Munger talks about show me the incentives and I'll show you the behavior. That Flight Centre is a great example of it. Everything was set up to maximize sales in that business and profitable sales. They work like little sort of localized independent businesses that operated under this Flight Centre umbrella. You could see it was going to do well, and it was in rollout mode. And that's when you make most of the money in retailers. They've proved the concept. They've proved that they can open a store profitably. If they can't, they shut it down quickly. And they don't run out of money in rolling out. Like the shops become cash flow positive quite quickly. And Flight Centre was doing all of those things. So I think we bought it at $3 and we sold out, I don't know, well over $20. Something like that. That wasn't the first time, but a retailer, I'm glad I didn't hang on to Flight Centre because they made that an amazing transition into corporate travel, which I think most companies wouldn't have done. And they managed to sort of not close down the retail chain, but shrink it and still have a very, very good business. Most companies would not have managed that transition, I don't think.
He's a ripper, Screw. He is a ripper. Yeah.
You also say in the book too, John, that not everyone is suited to be investor, and not every investment is right for everyone. Can you expand on that a bit more?
I'd probably go further than that and say I think most people should not be managing their own money.
Mm-hmm.
And I'm not just saying this because, you guys run the property couch, but I think if you're not investing in your house that you live in first and foremost, then you shouldn't be doing anything else. That's probably a big call. But, if you're young, getting into the housing market and having a plan to stay in it for the rest of your life is a good plan, I think. The problem with stocks is that most people are not predisposed to do it psychologically. Property investing, I think, is psychologically something people can do because it's just harder to change your mind about a property, and it's really easy to change your mind about a stock. So if you feel like, I can't pay my mortgage, you'll just work harder to pay your mortgage. Australians do not default on their mortgages. If you feel as though, the company that you're backing is not doing that well, it's easy to get kicked out or sell at the wrong time. And that's the mistake that most people make. We're not predisposed to dealing with difficulties and struggling through them. And in shares, it makes it very, very easy to change your mind. So I don't think most people should be managing their own money. I think most people, if they want to invest in shares, should be doing it through a low-cost managed funds, a Vanguard managed funds, and play 20 basis points or less, and just hang on. Do not sell when you most feel like it. They're the two things. Minimize your fees, contribute regularly, and don't sell when you most feel like it. And if you can't do that, then don't do it.
John, there's a lot of stuff around the behavioural psychology that you've got in the book around emotions can be costly, bias skews judgment.
Mm-hmm.
Is that was that something you were aware of yourself, or was it the pot's hot, I've got to touch it and learn that myself? I mean, did you learn that, or did you take those lessons from the books you were reading and then apply that, or was it a mixture of both?
No, it was a bit of both, really. I mean, if you read Daniel Kahneman, Amos Tversky, Thinking Fast, Thinking Slow, those kind of books. Michael Lewis's biography of Amos Tversky is fantastic too. If you can get to read that, it's an amazing story. But it was weird to me when a former research director said to me, he said, "Do you know of any other product where when the price falls, people panic about it?" Well, no. He goes, "Well, normally when the price falls of something that you really like in the supermarket, you tend to buy more of it. But in the share market, a price fall is taken as a sign of trouble, and sometimes it is. It's a confusing environment to operate in, and it kind of messes with our psychology." So that was something that I latched onto very early, and all of the behavioral economics that I read later from Thaler and Kahneman and Tversky and stuff like that just gave me that kind of theoretical background to it. But that research also suggests that even though you know about it, it's actually quite difficult to act on it. You can know all of these things about not selling when you most feel like it, but it's actually really hard to do. And if it was easy, the kind of investing we do wouldn't work.
Yeah.
So there's a ton of things that you do well in your book, but one of the things I've heard you speak about too, John, is success too early is dangerous. And obviously there's a lot of parallels between that and property investing because, there's many stories of someone who's had
right.
It was me who did it. It was me.
Yeah.
It was my genius.
Yeah. And I think that mentality is much more prevalent in men than it is in women.
Yeah.
Oh, yes.
Yeah.
Men are just much more liable to sort of ascribe good luck or good fortune to their skill and judgment than women are. So there's a big ego trap in this, especially for men, I think.
Yeah. I think
that's very true. Now, you also talk about valuation methods are consistent across assets.
Yeah.
Now, that's where, when we look at residential property, there's people buying it with their hearts and there's people buying it technically if they're investing, hopefully with their heads.
Right.
But in terms of other, valuation methods, EBITDA, and, all of the sort of different approaches that you might take in terms of valuing businesses, take us through that logic in terms of why you believe that, they're pretty consistent across all assets.
Well, take property, for example. I mean, the most common valuation method in stocks is price to earnings ratio.
Mm-hmm.
So earnings per share divided by price.
Yep.
You can do that in property. So if it's got a yield of, I don't know, 5%, that means that property is trading on a PER of 20. No, is that right?
Yeah,
4. Yeah, no, it's not
25, 20?
25, yeah.
Yeah,
So
25.
you can make those kind of comparisons. It's 4% would be 20. Is that right?
Yeah.
No. So that's one way that you compare property with shares in that kind of way. You don't have to look at return on invested capital, return on equity, those kind of metrics with property. But I do think there's a danger with looking at just metrics, because often the value is unseen. So when you were talking about brands earlier, you're talking about high quality management, you're talking about pricing power. All of those things are unseen. They eventually show up in the metrics, but there are things that this is really the art of investing. They're the things that are only revealed to you later on. And I think that's where the skill is. The skill is recognizing those qualities in a business that aren't necessarily in the finance metrics. Computers can do a lot of this stuff anyway. So I would say that if you're investing purely on metrics, there's no advantage to you doing that when computers can do that just as well as you can, if not better. You need to be looking for those things that other people and other machines can't see.
The intrinsic aspects or the market differentiation, and you're sort of referring to those types of elements.
I'll give you an example. So a stock that we own is Lovisa, which is a kind of low market position jewelry. So it's kind of disposable jewelry. Doesn't sound like a great business. But a former research director got on a plane to see their first 2 stores in the US. One was in San Francisco and one is in Los Angeles. And he spoke to somebody in the shop and said, well, how's it going? I said, oh, it's great. It's going so well. What about the store in San Francisco? He said, well, actually, I'm going there tomorrow. They've run out. We have to take more stock up there from the warehouse. I'm flying up there. So they've literally sold out. Now, that's the kind of stuff that a computer can't learn. You can go there and see that and see it work. Yeah. We've got another stock that we're recommending at the moment called AP Eagers, which is Australia's largest car buyer. And we went on a site visit to Brisbane a couple of weeks ago. And you can talk to the staff who are working in these giant secondhand car yards, and you can find out how the business model works. You can see the culture and the attitude in the staff. You can't see that in a model. You can't see that in an analysis of the data. So those on the ground experiences are things that I think, especially in retail businesses, but consumer facing businesses, where investors do actually have a bit of an edge. But it takes time. It takes effort. And if you don't sort of approach it as a hobby, almost as something that you really enjoy doing, I love doing that kind of thing. Yeah. But if you don't enjoy that kind of thing, I don't think it's worth the effort for most people. You're better off just investing in that low cost managed fund and not selling.
Yeah.
John, tell us a little bit about 2004. You get a leukemia diagnosis, which you've obviously that initial time frame that was given to you is well and truly been surpassed. But
I'm still here.
Yeah. How did that change your views on where you wanted to go? And when all of a sudden you're actually given a finish line.
The finish line, that's right.
in terms of the diagnosis that you were given, how does that affect the in it for the long term, playing the long game, all those sorts of things? Did it change anything around the way that you're seeing your money and your investments at that point in time?
Yeah, it did. It kind of changed a lot, actually. I didn't. I mean, at that point, I felt as though I always felt a sort of weighty financial responsibility to my children. But even at that point, we had a nice house in Byron, we had some money in the bank, we had a portfolio. If I dropped dead the next day, I felt they would all be fine. So I didn't feel as though I needed to build that in any way. I don't think it's a great idea to leave your kids a huge amount of money. I think that in some ways can be the worst thing for them. But there was certainly enough there for them to get a decent education and live a decent kind of life, or a decent kind of start in life. I think what really changed for me was that I started to value non-monetary things a lot more. Just time that I had with the family, the priority I put on that compared to work. I still love work. I still really enjoy what I do. But I think we probably all obsess a little bit too much about money and its role in our lives, and can be a great source of anxiety, especially if you haven't got it. But if you do have it, it can still be a bigger source of anxiety. I mean, I know a lot of wealthy people who worry about money a lot, and they really don't need to. It kind of comes with the territory. So I feel as though I got over that quite well.
It's that whole money controlling you versus you controlling the money.
Right,
And I think
that's right.
I think, someone who's run a business and been successful, sold and repurchased and played in that space, I think you do take a lot of comfort. It's probably similar to someone who's had a career prior to reinventing themselves and being successful in a second environment. You sort of get a bit of sense of, okay, I think I can sort of manage myself in different situations, which then gives me a little bit of confidence around that. And I think, from someone who always used to worry about money a lot, in the household that I grew up in, and also early in my early 20s, I was always paranoid about money, to being where I am now, going on that journey of financial security and financial comfort. I think it does take time. I don't think anyone who, everyone has, is living in their skins in themselves around how they think about these things. And ultimately it's, there's no substitute for the journey that you go on and the experience. And then to your point, then when you start doing experiences, and then those experiences carry so much more gravitas than the cash you got in the bank,
right?
Because at the end of the day, you only have one life, right?
That's right. And I think if you do have your health, like, you can recover from anything, really.
Yeah.
No matter what you go through, if you have still got, you're in good physical and mental condition, you can recover from it. And if you know that and you've got that, it helps you endure the more difficult periods in our lives, which we all experience in some way, one way or another.
Agreed.
So John, my final question for you is an extension of that. But I recently read a book, Never Enough, by Andrew Wilkinson, which is from barista to billionaire, and he went through this journey of climbing the mountain, then realizing that wasn't what it was, and giving back, and sort of a similar theme to the conversations that you just had there. But have you worked out how much is enough, and what? So part A and part B is, how would you mentor our listeners with that very question? Because to Ben's point earlier, where we're trying to show people not to touch the pan to burn your hand, but most people need to touch the pan to realize that it wasn't to be touched in the first place. So have you worked out how much is enough, and how would you mentor people to answer the same question for themselves?
Well, I suppose everybody has to work that out for themselves. I mean, you can tell people, look, we're lucky just to be born and to live here, right? I mean, I think that's part of the trick, is just to think about people. If you've been born in the West, especially in Australia, you've already hit the jackpot. And the only thing that stops us from realizing that is because we don't see how 3 or 4 billion people around the world live on a daily basis. So I think instead of looking up and seeing how much we haven't got in comparison to the people above us, we should look down more. That's what I would say to those people in answer to your question. Compare yourselves with those who are less fortunate than you, than who are more fortunate.
because, John, most of the people are spending their time on these social envy sites.
Yeah.
And
Yeah,
all
that's
they're
right.
seeing is the looking up,
Yeah.
right? They're not getting that whole context. I mean, you in your traveling experience, and obviously, throughout life, you've been able to travel different locations, and that gives you context, right? It gives you grounding in terms of that story. Travel and looking at other cultures and other experiences, it is the great grounding of anyone's understanding of meaning and life and what they're doing. And if you can do that, I think that's an unbelievable opportunity to give you some context of just how wonderful we have it here, and
That's right.
stop bitching and get on with living, right?
That's right. That's right.
My final question for you from where I sit is, you've written this book. It's taken you a little bit longer than you originally thought it would in terms of pulling it together.
Yeah.
What are some of the sort of core lessons that you would want the reader to take away? Obviously, they'll have to buy the full book to get all of those lessons, but just pick on one, that you might be thinking, if I land this message, I'm really happy in terms of the execution.
All right. So welcome the mistakes, take responsibility for them, and learn how to sit still.
There it is.
It's brilliant.
Sage advice from someone who's been there and done.
Who can't
that.
sit still.
Oh, that's brilliant. Well done, John. I mean,
Thanks, Bryce. Thanks, Ben.
Your thesis is very simple.
Yep.
Buy a well-diversified portfolio of ETFs. Manage your costs rather than your returns, and critically, don't sell when you most feel like doing. I mean, for your mission when you first started Intelligent Investor is to make it understandable to folks. That is the epitome of understanding what it takes to be successful. So we're going to put all the details in our show notes on how you can get a copy of John's book. It's an incredible read, folks. Obviously, you've just had a little snack into how his mind works. He's clearly a very well-read man. He's got a lot of experience. He's applied it himself. He's obviously had some philosophical reflections on his own life with some of the things that's come your way. So on behalf of everyone here on the Property Couch podcast, John, first of all, congratulations on the book.
Thanks, Bryce.
Thanks for joining us on the Property Couch.
It's been great. I've really, really enjoyed it.
Yeah, and if anyone wants to learn more about the Intelligent Investor, we'll also put those details in the show notes. There's some obviously excellent weekly articles. You're building basically up a framework of ideas, and also, John's given you a couple of tips in terms of some of the businesses that they're interested in. So if you want to be an active investor, then you still want to have people like John in your corner helping you out as part of that particular story. So we'll put some details in terms of getting some links to those show notes as well.
Thank you, John.
Thank you.
Thanks, John.
There you go, Ben. How good was that? What people don't know is once we finished recording there with John, we had a little conversation afterwards, and we thought let's catch up. Let's have a share a beverage or two and trade some stories. And
John's back in Melbourne now, so we're going to have a chat. We'll show him around. There's a nice little pub on the corner called the Courthouse. We'll go up there for a quiet ale.
Yes.
We'll get to know each other a little bit more. But hey, Bryce, you can recover from anything.
Yeah.
I've just written it, as he was saying, obviously adversity, a few changes in his life as well. So he's showing that resilience, to your point around, sort of what was the mindset theme at the start, recovering wisdom, challenges, mistakes, overcoming them, getting around them, being still optimistic, open-minded about the opportunities. I love what he also said about the greatest country in the world, being born here, being very fortunate to have that story as well. So, yep, you can recover from anything. What a great little message there.
I love it. Philosophically, Ben, if you strip away that he has a strong interest in stocks and shares, we have a strong interest in property, take away the asset class and just talk about philosophies, we were perfectly in alignment with John on the way he sees the market, the way he thinks about it. And in terms of his simple philosophies around investing, it's pretty much, diversify into ETFs, don't make sure you maximize costs, and don't get out even when you get tempted. Like, tell us that there's not some similarities across our lane as well. I love the bit where he said, if someone has 10% commissions, Ben, they have to work pretty hard to get someone into that investment. Yeah. So to quote him, he said, something's wrong. Well, that applies to property as well.
100%.
But most mistakes are psychological. I love that because we say money is simple, behavior is hard. And the longer and longer and longer and longer that we do this, Ben, the longer and longer we do it, the more we realize that if you can game the behavior stuff, the rest is just so incredibly straightforward. So I love that as well. But
and there's a hands-on and a hands-off process. Hands-on, basically good businesses study them or get someone who's learned how to study them and follow them and buy into their system, or ETFs.
Yeah.
Pretty simple.
Yeah, pretty straightforward.
Yep.
Started out with money being dirty, has a 5-year gap with his brother. Money was really tight when he was growing up, always had that fear of not enough. And then, as we asked the question at the end, he really started to reflect on how much actually is enough. That's probably the favorite part of my interview, despite all the nuggets of wisdom that he dropped, Ben. I feel like I'm so incredibly passionate about that one particular part for our community, because once you actually do have a very thoughtful realization around how much is enough, you probably will find yourself realizing that you're probably closer than you think you are, and you can let go of some of the other rubbish that comes from it. But John, we certainly appreciate you giving up your time, your energy. Here, for those watching, here's a copy of his book. Make sure you go and get it. We've got a joint publisher, Leslie from Major Street Publishing, connected us with John. We're very appreciative of her, appreciative of Leslie doing it. But get your hands on it. It's a great read. And we'll put all the details in the show notes here. So, hey Ben, my life hack today is so last week you gave me a little ribbing about the bracelet life hack. So I've really gone into our team of Stigs here.
Okay, what do we got?
I said we
need
your
last one for the year, mate. So
last one for the year. Got to go with a bang. And so so this is the one that Artie talked to me about, and I think it's a ripper, mate, because we are actually in holiday season, and quite a lot of people jump on different forms of transport to get to different locations.
Yes.
So she showed me this way that if you have a photo, she had a if you're watching this, you'll see it, but if you're listening, she had a photo of the itinerary for her daughter that flew over. I'm pretty sure it was Japan from memory. And in the image of the photo was the flight number. So all she needed to do is press on. This is just a photo of the flight number.
It's the airline and the flight number.
Press on the flight number in the image, and all of a sudden, this is on an Apple phone. All of a sudden, it came out and expanded into a flight, so you could see the flight path of the plane. So not only where it was taking off, whether it was on time, where it was landing, but you also got a status of the particular where the flight is, because she was, she's got a young daughter. She was frantic about the location.
Is it halfway in the sky? Is it? Yep.
So how good's that? Apple, hey?
That's pretty cool.
Press on the image. A bubble, like another breakout window will come up, give you the status of where the plane was. I thought that was pretty cool. So
that's a nice bit of AI tech, Bryce.
So thank you for Art for giving that to me. But that's pretty good. So Ben, based on last week to this week, how you happy with that as a life hack? Or
I think it finishes off pretty strong. I think you've got a combination of AI in there in terms of what the future is going to be looking like. The fact that I can, all of the heavy lifting's done by one finger tap to get me into insight really quickly.
Yeah.
I think that's as good as any sort of hack that I can think of recently.
Got the Ben tick of approval. Thank you, mate. What's making property news?
Bryce, there's still all this debate about sort of superannuation, right? And superannuation for property purposes. So I thought we'd finish off by sort of thinking about this, because there's different people in different camps, and we're seeing lots of new stories about, what Liberal Party and what Labor think about whose super is it and whose money is it. Well, at the end of the day, the money belongs to the person, right? And fortunately or unfortunately, the government worked out many, many years ago that you weren't going to have enough money. So they've got forced savings. You can't touch it till you get really old. But now there is this sort of debates going around about, should it be used for a deposit for a home? And so that's part of the Liberal policy's position around that. But the new debate is about, what if I've got, say, $100,000 or a couple of $100,000, and let's say maybe I've got $50,000 of that in cash? Is it sensible to put that $50,000 onto the offset? And so make the interest charge lower, which means I pay off that mortgage quicker. Now, I reckon if you're asking a bank, person, they might say, and someone who owns shares in a bank, they might go, "Oh, I probably don't like that idea because those interests that we charge is the profits that fall into the share price and into my pockets eventually." But I think it's got to be a debate that we have now. I'm sitting on the fence on this one in terms of whether I like it or I don't like it. But the idea that you can quarantine an amount of money, and as part of the investment options you have for that money, that you can put a portion of that on your offset. Can't use it for anything else. The bank's technology would be able to lock it away, so you wouldn't be able to get access to it to go and buy a car or do anything silly like that. But effectively parking that money there to actually offset that, so you pay less interest over the long term. It's got some merit. So so part of me sort of says I like that because you're paying less interest, pay off your home loan sooner. The other part of me says, what's the behavioural element of that? If I've got that $50,000 there and I also had 50,000 of savings, will I then start to spend that 50,000 in savings? Like, will it have a net overall benefit? For some households, it will, who are diligent and believe in delayed gratification. Because also remember that if I do pay it off, and these days, if I own my home for more than 10 years and I'm over 55 and I sell that home, I can put the equivalent of $300,000 for me and potentially my wife or partner, and that's $600,000 that can be re-injected back into your super fund with no tax consequences. So I quite like a bit of that idea in terms of how I'm able to move those things around and still provide for my retirement. So I can see both sides of it. I probably just need to do a little bit more slow thinking before I finally land on which side of the debate.
Makes sense. Yeah, there's a whole bunch of pros and cons in that really need to be considered. But it's good to see that there is still conversations around prioritizing what is arguably the greatest thing you can do to make sure that you have the best retirement, is to have a roof over your head. So
property.
Thank you for that, mate. Thanks again to John for an incredible opportunity to chat with him and tap into his insights and his wisdom. And again, get yourselves a copy of his book, mate. But until next week, Ben.
Knowledge is empowering, but only if you act on it.
There we go. See you next week, folks. Enjoy summer series.